and developed markets saw a rally in May after President Trump temporarily halted his tariff policies. In contrast, mirroring emerging markets, the PSEi ended the month with a near 0.25% decline, exacerbated by MSCI-related outflows. It mirrored declines in emerging markets, all struggling to keep pace with the recent surge in U.S. yields. This driven by Moody's downgrade of America's credit rating, dampening investor appetite for riskier assets, says Ron Acoba of Trading Edge. Looking ahead, Acoba anticipates the PSEi to consolidate and move sideways. However, a potential rate cut by the Bangko Sentral on June 19 could rekindle investor interest. With us now for more is Japhet Tantiangco, Research Head at PhilStocks Financial. So good to see you again, Japhet. Welcome back to the program.
Good morning, Ma'am Kathy. Good to see you too.
All right, so put us up into context here, because how is it that developed markets actually posted gains in May on a month that we'd been troubled about the pause? Emerging markets fared not too well, as you've seen, PSEi down by about 0.25%.
Well, overall, it can be attributed to the confidence towards the strength of their economies. I mean, right now, we are really in uncertain times. We have heightened uncertainties, heightened risks because of what the U.S. is doing, particularly with its protectionist trade policies. And of course, there's the downgrade by Moody's, which caused yields in the U.S. to rise. And during times of great uncertainties, of course, investors tend to go to those which are relatively safer. I mean, if you're going to talk about sentiment, investors right now are in a risk-off sentiment. So, they're really going to avoid or minimize risk as much as possible and go for safe havens.
But I would have thought that emerging markets like the Philippines would have been the more resilient ones because it's been least exposed to the global trading uncertainties. But it appears now that we're seeing the cracks there, especially with manufacturing, as Sunny had explained, that we don't really produce the high-end products that would really make us competitive.
Yep. Yes, it's true that somehow the Philippines is not that as exposed like other countries with respect to the global trade problems. But at the same time, I mean, we still have problems of our own. I mean, if you're going to look at the local economy, I mean, we're not as growing as fast as before. And at the same time, of course, as you've mentioned, we have our manufacturing sector, which, unfortunately is not as competitive as the others. I mean, yes, we are still on the lower end of the global supply chain. And so investors are also looking at that. And of course, the global trade uncertainties, yes, if we're going to talk about direct effects, it may not be that much. But indirect effects, there will be a lot to the Philippines, especially with the two top economies right now fighting, the US and the China. And of course, because of that, investors will still, go for the relatively safe economies. And of course, the Philippines is not one of them.
Not one of them.
Yes.
In spite of the fact we had a midterm election that really boosted consumer spending in at least the first 5 months of the year. I just wanted to show some graphs here because very interesting. In the midterm elections that have passed, in those years, in 2013, 2019, and this year, mixed picture. Couldn't really quite get a trend here. If you take a look at 2017, I'm looking at declines in the PSEi, but then an increase in the 2019 midterm election year. So what does that tell you?
Well, with respect to the midterm election years, we've had mixed results. 2013 we've declined, 2019 we rose, and then finally 2025, at least for May, we declined again. But I believe this can be attributed more to the economic environment that we are moving in back then, or the factors that, the other external factors to be considered. Like, for example, in 2013, we were having problems because of the so-called Fed taper tantrum, wherein they said that they're going to reduce their monetary policy easing, their quantitative easing, and that in turn caused a spike in yields, which in turn caused the market to decline back then. And right now, the story is similar. Yields in the U.S. are also rising, but for different reasons. This time it's because of the global trade uncertainties, and that caused the market to decline. So I believe the decline in 2013 and in 2025, This is more attributed to the external factors at play, which negatively weighed on sentiment.
Well, let's take a look at it from another way, because Trump's 1.0 and 2.0 also have different outcomes so far. When we look at the markets, just taking a look at the chart, just revisiting that, we've seen a more benign picture, I would say, in Trump 1.0.
Yes.
What made it a little bit more toxic for 2.0?
Okay. That's going to be 2017. Trump won, the first term of Trump started in 2017, and then the second one is 2025. It can also be attributed to the other factors at play. In 2017, investors were optimistic because, number one, I mean, you had back then President Duterte who was promising to prop up the local economy through his Build, Build, Build program. And that in turn caused investors to expect that, okay, so because of this infrastructure push, the local economy would be able to sustain its growth momentum, which is at 6%. So we had a positive economic picture back then. At the same time, Trump didn't immediately start his trade war in his first term. The very first time that President Trump pulled the trigger on the trade war was in 2018, and that is by slapping China with 10% tariffs. This time around, it's different because this time, as soon as Trump took the seat in the office, he immediately pulled the trigger on his protectionist policies, and that in turn caused an immediate uncertainty within the market, which caused us to decline or caused us to have, somewhat a negative performance in the Trump 2.0.
Interesting, just looking back at that and how tired we've become of just like to and fro. Let's take a look at the second half of the year then, because it seems that everyone's just hoping that policy rates will come lower. That's the only lever left. To invigorate, at the very least, the stock market. So what are the expectations, and how should investors position then? If indeed we already know what the risks are and how risk appetites have come through, how do we then act or react for the second half of the year?
Well, for the second half of the year, what could happen and how could we act? Well, number one, yes, the main driver or the main thing that's supporting the market right now is the expectations of policy rate cuts by the BSP. And of course, given the picture that we have right now, slowing growth, slowing inflation, peso is strong, there's a possibility that the BSP could still grow aggressive. 75 basis point rate cut is on the table. But of course, that's just one side. I mean, there are, a lot of things need to happen in order to, to boost the local economy, in order to bring the local economy back to its glory days. And so I believe this is what investors will be watching out for. It's not really just about the rate cuts, but in general, how would the local economy perform? And of course, is that going to trickle down to the corporate sector? And
so is it a wait and see then for equities?
Yes, it's most likely going to be a wait and see. But at the same time, okay, so let's talk about fundamentals and sentiment. I differentiate the two things. Fundamentals, we are at bargain levels. We are below average PE, historically and regionally speaking. So a lot of stocks are at bargain. But are we expecting stocks to rise in the short term? Probably not yet, because of the ongoing sentiment that we have right now, plus the wait-and-see attitude of investors.
I'll hold on to that and hold on to some hope. Thank you so much,
You're
Japhet
very much
Tantiangco.
welcome.
Appreciate it. PhilStocks Financial.